I was working in an IT company. My salary was 10,166 rupees. I had 5,000 rupees that I had saved for my salary, and that is how I started. Time was different. Stocks were available, cheap. Today, any stock that you think, will fall into a good category, you will not find it cheap. So from 2021, it was 2.5 to 2024, it ended up at 15.8, nearly 5 times. Valuation is in the eye of the beholder.
Hey guys, welcome to another episode with me, Shashank Udupa, in the Connecting the Dots podcast. And in today's episode, I've got a phenomenal guest called Abhishek. Now, Abhishek is also the founder of IntelSense. I've been reading his reports quite recently and it's amazing. And he also runs a PMS as well. Now, this episode is going to be power packed with a lot of stock examples, psychology of investing, and a lot more. So stay tuned. And if you're not subscribed to the channel, please do that right now. Let's begin. Hi Abhishek sir, I'm very excited to do this podcast today because I have been reading your Value Picker threads from a very long period of time and I know you're like a legacy part of Value Picker. I recently also read your textile report that was done by your company called IntelSense and I also know you have a PMS. So first things first, I want to understand your journey as to how you've reached this point because you've been an investor from 2000, right? So I want to understand that journey from you.
So first of all, great talking to you. I think the journey was like any other, person who gets into investing. I had no background. I mean, no family. No one had invested in the stock markets before. I come from a typical middle-class Bengali family. So studying is what is sort of, looked up upon. So when I just 2000, I started working, and a friend of mine gave me a book called Rich Dad Poor Dad. I read it overnight, and it sort of struck a chord with me that, I've seen people all around me working their entire lives and not being financially free. And I didn't want that to happen with, my life. So I said, looking at that 4 quadrants that Robert Kiyosaki talked about, running a business at that point in time was difficult, right? You don't have a background, nothing. You just got into a job. And the other was being an employee, which I was. And so SEBI, so self-employed, employee, business, or an investor. So the only easy way out for me, who had no knowledge, no money, was to become an investor. And till today, I think it is the lowest threshold. And that is why today you find so many people, joining the stock markets without any knowledge, without any understanding. And then they sort of build up. So that's how I started. 2000, I started. And that I was lucky because that was the time when the online brokerages was sort of coming up. So I opened an account. My first, I had 5,000 rupees that I had saved for my salary, and that is how I started.
But what was your salary? I mean, what were you doing at that point?
I was working in an IT company, just joined. My salary was 10,166 rupees.
Wow.
And 5,000 was what I'd saved the first month. I put that in the brokerage account.
So, but if this was in 2000 and you're from an IT background with no financial understanding, wasn't the sentiment bad in 2000? Because that time the Y2K thing had fallen down, the markets had crashed.
No, in fact, it wasn't that bad, or maybe I was that ignorant that I did not know anything. Okay. Right? So I just sort of thought that the next 20-25 years I need to invest and create a corpus so that I don't, at some point in time, I will have enough money so as to step away from a job.
Got it.
So that was the idea. I still remember that was a time when Nifty was below 1,000.
Wow.
Right? Sensex was below 3,000. And that, I didn't have any knowledge. I did not know what EPS meant. So, and getting that knowledge also was difficult, right? Yeah. There was no sources of information easily available. So you had very few books. And that is why I think most of us who started around that time or before started off as value investors, because the books that were available were from, Warren Buffett way, Peter Lynch's books, and that's about it. And then you had to sort of, work your way around and figure out.
So how has your journey evolved over time as an investor? Because you said you started with value. So how has your journey evolved?
So started with value. Over the next 10 years, I think 2000 to 2010, predominantly moved from value slowly towards GARP, right? Growth at reasonable price. Then slowly more towards more growth.
Okay.
Then I think 2017-18, I started. I fortunately or otherwise, I read a lot. So I came across a couple of books where I found a representation of long-term returns of different investors, traders, and there I was surprised for the first time to find that for me to be a really good investor slash trader, you have to have at least 15-20 years of track record, right? And I found that there were so many who had done phenomenally well for very long periods of time. And in that list, actually, Buffett came in at a very low, rank, because although Buffett has the advantage of very long-term compounding, his rate of return compared to some of the others was lower. So that piqued my interest that, there are other modes of or other styles of investing that I may be completely either unaware of or disregarding. Right. So typically what happens is you tend all fundamental investors tend to scoff at technical.
Correct.
Right? They're like, yeah, what is this? Chart smarts kaun dekhta hai, right? That kind of thing. And most of them have no knowledge about technical analysis, why it is supposed to work, or does it work, or they've not really studied it enough. And this coincided with we going out as a team in Value Picker. We started going out in offsites, right? So we had these very intense 16-18 hour a day sessions in Goa with the Value Picker team, and it was like 16-18 hours a day only talking about investing. Right?
Wow, so lucky.
Like 10-15 of us. And there I for the first time met Hitesh Patel, a lot of the other folks who've now have become very close friends. So from Hitesh, I mean pretty much everybody calls him Hitesh bhai. So I started first time realizing that here is one guy who sort of marries technicals and fundamentals.
Correct.
And I'm talking about 2014-15, this
Correct.
period. And I said that, okay, so he's so successful, which means that there is something in it, right? It's not completely nonsense. So then I should learn it. So that is how I chanced upon technicals. Once I started learning technicals, from there I chanced upon, okay, if there are these indicators, can we quantify it? Can we then build systems? So from there, slowly the progression onwards to quant-based systems. So right now, I think my mind is basically a hodgepodge of fundamental, technical, quant, systematic investing, trading, whatever you call it. So all things, it's like a pot of all of these things put together.
Wow. Now, I want to touch a little bit more on Value Picker, right? Because Value Picker has been one of the most amazing websites that is there for retail investors in India. Like even I spend almost 1 to 2 hours every week just to read upon stocks from day 1 to day 100, right? Now, I want to understand little early days of Value Picker. What was the thought process behind it? Because 2014, you're saying, तभी तो कुछ था ही नहीं ऐसा.
So we started Value Picker in 2010. So what happened was Donald, he sort of got Value Picker going, and initially the plan was we'll make it like a screener, right? Oh. And then and Ayush was there with us, and Hitesh, myself, and a few others. We sort of got together, and we were sort of from that screener part. So the screener did not take off initially, right? Then we started thinking that, okay, let us, because we were all doing a lot of research on typically small caps, mid caps, micro caps, stocks which were not on the radar of the big institutions, right? Hardly any brokerage coverage, stuff like that. And we started thinking that, okay, then let us start writing stock stories, right? And that is how today's, these threads got started. So now when I look back at some of the threads of 2010, 11, 12, 13, 14, some of the stock stories I've written or initiated, it seems like a dream that this was a stock which is some of the stocks like Deepak Nitrite or a lot of these stocks. Nobody was talking about it in 2012, 13, 14.
Wow.
And we started looking. So you look at PI Industries, look at Astral, you look at Mayur Unicotors. Manjushri Technopack was there at that time. It sort of got privatized, I think. A lot of stock stories, Ajanta, Pharma. So a lot of these stock stories we wrote primarily for our own consumption.
That's crazy. Now, before we go into stock examples and all that of the past, one more thing I want to ask you. You said you guys found Deepak Nitrite, Ajanta at that point, right? From a thought process standpoint, I don't want you to go deep into the stock, but from a stock, thought process standpoint, what were you looking at? Because finding those type of companies which were multi-baggers today, like if I'm sitting today and finding out how do I...
So the idea was never to, find multi-baggers. I think multi-baggers are only known in hindsight.
Correct.
Right. The endeavor remains the same for us even today, right? What we started off, even in those days, still the research remains the same. We look for companies where it can grow over extended periods of time, where valuations are reasonable, where management is walking the talk. I think that is what essentially we are looking for.
Okay.
Right. Some reasons why some of those stocks did really well was because that market time was different. Stocks were available cheap. Today, any stock that you think will fall into a good category, you will not find it cheap.
Yeah.
Right. So 2010, 11, 12, 13, 14, that period, there were stocks which were available at 10, 12, 15p. Right. So 20p seemed to be, you have to think, we'll give 20p, this is expensive.
20p was expensive at that
right, 20, 25p, we don't want to pay 25p, right? We're looking for single digit Ps, we're looking for, 12p, 15p stocks.
Wow.
Right. But the market context changes, right? Liquidity changes, a lot of things change. So you cannot fixate on the fact that today, in today's market, I will get at 8p. Right? Maybe at some point in time, you will get another time like that. But today is not that time. And I've been saying this consistently, last 7-8 years. It will be very difficult for us to go back to those days where the market was lot more undiscovered than what it is today.
Correct.
Right.
Correct.
So those days may be over for a very long period of time.
Got it.
We may not get back to those levels.
So now, your fund, from both from a PMS and advisory standpoint, what do you do? Do you do quant, GAR? What do you focus on?
So essentially, like I said, my stock picking today is a combination of myself, my thought processes. So it's a combination of fundamentals and quant. In some cases, in the longer term picks, it is probably more of the fundamentals, slightly lesser of the quantitative side. And in the shorter term momentum kind of funds, it is the other way around. So it's more of, getting in, out, getting the short cycles right, rather than, focus a lot more on the fundamentals.
Now, I want to understand now, based on your stock picking and how you have selected stocks in the past, what were the things that you saw? So can we get into screen share mode and understand a little bit for the audience as well?
Yeah, okay.
Okay, let's go.
I was looking at Elecon, and if you look at the numbers.
Yeah.
2021, what happened was, you see the sales already starting to pick up.
Yes.
Okay. And the other important thing, if you see here, is that the margins have dramatically improved. So 2019, 11%, 2020, 13%, and then 2021, it is already 18%. And I'm buying it at around August. So all these numbers are public, right? If you look at the next important thing is the interest. Interest paid out is decreased. And that is showing up at the PBT and the PAT levels.
Wow.
Right. The interesting part here is, if you look from say 2021 to 2024, they actually doubled their sales.
Correct.
Right.
Almost at a 20-25% growth rate is going on.
Correct. And if you look at the PAT or the EPS, And look at the growth. So from 2021, it was 2.5.
Correct.
To 2024, it ended up at 15.8.
Wow.
Right? So nearly 5 times. Now, if you look at the balance sheet, 20 March, you see it was, borrowings were 420 crores. Next year, decreased. The following year, half. The following year, one third.
Wow.
Right? So automatically, and interesting part was they were already talking about this in 2021, that our intent is to reduce debt.
Okay.
And the other thing that we could see was some form of capex happening in steel companies, in cement companies. So all where Elecon was supplying.
So what does Elecon do?
Elecon makes industrial gearboxes. So industrial gearboxes are used in all kinds of large machines.
Okay.
Right? So 2021 they had got their orders from the Navy. Right? Decent orders. I think top line was about 1,000 crores. Their order book at that point in time, if I remember correctly, was around 380 or 400 crores. So you could see at that point in time, so this slide, it actually shows you that at the PE itself was significantly depressed.
Yes.
Right? You are buying something cheap because nobody is looking at it. Because for many years it has not done much. And then the cycle turns.
Correct.
So that is what you're looking for. And remember here in Elecon, we were not buying hope.
It was all factual.
It was actually, if you see the numbers, if you just look at up to March 2021, the numbers have started coming. Debt has started reducing. Margins have started going up. Right? So at least a part of the story that was being told is there in the numbers.
Got it.
Right? That is what we were looking at.
How did this come up on your, if I had to find such companies, how do I, today if I had to find, do you have a screener or do you read a lot?
So it's never one thing. It is not only a screener. It is about, one is obviously you have to read a lot about industries, about what is happening, about different themes. As an investor, your primary job is to absorb as much information, and what I say is primary information as much as possible. Primary, sometimes even secondary information. And then you have to synthesize that information. Very difficult to say that, where did I get this idea from? I honestly today, I do not know. Same, in a very similar kind of mode, I'll tell you, we picked up Cummins when everybody else was selling, right? A few years back. And my logic was that everybody is fixating on the fact that Cummins makes gensets. And because power situation is improving so much and the government is sort of banning diesel generators, Cummins is going to sort of have a lot of trouble. That was the ongoing market narrative. My thought process was that, one, I have not seen even till today any real estate apartment building block coming up which does not have a genset as backup.
Yeah.
There are no hospitals, retail malls, anywhere, offices where there are no gensets, even though power situation is much better, right? But gensets are still there.
Yeah.
The other big trigger that came to my mind was that data centers will definitely pick up because of the quantum of data we are consuming, right? And once that happens, you will definitely need power backup in data centers.
100%.
So data centers, this was one way of playing.
Okay, one question here. What stop losses do you keep in your portfolio? This is because retail audience also needs this question, right?
So stop losses is a very, very interesting question. So what I use has evolved over the years. We use what is known as multivariate stop losses. So you have multiple variables.
Okay.
So you're not using one system. But I think, if you have some simple system, something, you use some moving average. You can use if you're a long-term investor, you use a 200-day moving average, or you use some kind of an ATR based stop loss, or you use some kind of drawdown from the top. So you say that, okay, 20% drawdown from the top, I'm out. Or 30% or whatever. Okay. So some fixed number and you are out. So you can use something like this. The other important factor, which I think very few people or practically no one talks about, is having a time stop. That you buy a stock, you have a thesis, but nothing happens. You don't know the future, right? You are hoping something will happen. The stock continues to consolidate, doesn't go anywhere. At some point in time, you have to call it a day.
Correct.
You have to say that, boss, I have been wrong either in my stock selection or in my timing. Right? So this timing part was something that I was completely ignorant of before. But after learning technicals, after learning quant, it is something that I think is something that you should try. You cannot get everything right all the time, but
Correct.
At least the effort to make a reasonable entry exit timing should be made.
And if your timing is good, every quarter that will reflect in the stock price because your thesis is actually playing out.
Yeah. So you look at any good company where, you look at the price chart of, say, HDFC Bank from, say, 2000 to 2020. Consistently, it has gone up, right? There will be intermediate falls because of global factors.
Correct.
At 2008, it would have fallen. 2014, it would have fallen or something like that. But it is one upward journey, right? So that any company which is delivering, end of the day, a price chart, technicals, is derivative of the fundamental earnings.
Absolutely.
Right? So if a company continues to do well, the stock price will do well, even if there is some lag in between. Sometimes stock will do fundamentally better before the price starts picking up. Sometimes it will be vice versa. Right? Sometimes the stock will run up before you actually see changes in the in the company.
So do you see valuation peak outs as well?
This is a very interesting question. I used to do that. Astral Polytechnic. I sold when roughly it went and hit 100 P.
Oh, wow.
And I don't know what P today it is, but what I could figure out was when I sold, even from there, it is up 3 times. So that couple of other examples I had, Symphony, I made the same mistake. I sold out on valuations.
But you wouldn't say it's a mistake, right? Because 100 P is 100 P. It is expensive, right? I mean, from any angle.
No, so the way I look at it, again, is valuation has 2 components. One is the intrinsic valuation.
Correct.
Right? Which is derived from the cash flow, the basic fundamental numbers, right? The other part of valuation is the intangible part, which is what I call transaction value. So if you look at, for example, the Mona Lisa, right? What is its value?
Very weird to put a value on.
It has no value. If you do a DCF, it does not give a cash flow.
Yeah.
Does it have any value?
No.
Does it have any intrinsic value? It has zero intrinsic value. Because you can put it up on the wall for 100 years, you don't make anything.
Yeah. Only people like me will pay that charge and go see.
No, assume that it is not being paid a charge. I mean,
then absolutely
right?
nothing.
Zero. It's on a wall.
Yeah.
No cash flow, right? So zero value. But there is somebody who's willing to pay millions of dollars to buy that.
Correct, because he's seeing something.
So he's seeing something. So it has a transaction value. Same for gold. It has a transaction value. Same for Bitcoin. It has a transaction value. What is the intrinsic value of gold? Zero.
Correct.
What is the intrinsic value of Bitcoin? Zero. Right? So the point here is that valuation is a composite of these two, intrinsic valuation and the transaction value. Most of the time, people fixate, and this is my prime complaint against value investors, is that they fixate on the intrinsic value.
Correct.
They miss out on the transaction value. There are people who are willing to pay 100x for, or whatever x for buying into a story.
Yes, I've seen that with like example in today's market, Trent, right? It was at 200p and I remember people were buying 100p, people are still buying right now.
Right. So the point I'm trying to make is that there is a lot of subjectivity in valuation.
It's not clear cut.
Valuation is in the eye of the beholder. That is my favorite saying.
Got it. Got it. So in Elecon's case, so you had both EPS and PE re-rating.
See, the biggest money can be made if you get EPS growth and PE re-rating.
Correct.
It's as simple as that.
Correct.
If you buy at 15p and you end up selling at 60p and you get a 25% CAGR in between in earnings, you will make a pot
The
of
double
money.
engine growth you've got.
It is a double.
So this was a six-bagger in 4 years. Wow, that was crazy. What is the other example that you have?
So
here?
the other example was slightly different. Here, I'm talking about PG Electroplast.
Correct.
Now, this is a company which, we looked at we bought in February 2023.
Before the EMS became.
No.
Oh.
This is very interesting because this was a stock, I'll have to remember. So, in the next slide, I have got this. This stock had a rally from 2020 to 23. It was up 40x.
Oh my God. Okay.
Okay, so is exactly the opposite situation of Elecon, right? Elecon, it was dead and nobody was talking about it. Here, the stock was up 40 times, not 40%, 40 times,
Wow. Okay.
right? In that period. Then we bought. And from there also, it had done really well. And here, if you look at this chart, you see that the PE has not re-rated all that much. The PE has actually gone up significantly,
Yeah.
right? It was like from 40, it had peaked out at
140.
sort of 140.
Yeah.
And also earnings growth has been consistently good.
Correct. This
Right?
is even I think from 2021. Actually, even from the past. it's
Even
been-
now,
Even now it's
even
growing.
now, they are growing at 60-70%.
The guidance was 70%. I
Yeah,
think,
so
last
every quarter they are growing at 60-70%. So there are stocks like this where once in a while you will get a sharp pullback.
Correct.
As long as the growth continues, sometimes the momentum will continue. Sometimes it will not. So that is where the judgment part comes. It is not science,
Correct.
right? When you are building a quant-based system, why isn't all your stock picks doing well? Right? Because there is a factor where you are dealing with the future. There can be things which are happening which you do not know, right?
Yeah.
Which is completely out of syllabus.
Yeah.
That's how it is.
Got it. And these are like very good success metrics that you've shown, right? Anything that you thought would do well similar to this but didn't, like some learning that you found very early on, you caught it, or maybe you didn't catch it and you took a loss, right? Anything that you found?
Lot of such stories. Life is littered with stories where you've liked a company, it is not done well, or vice versa. You've looked at a company which you thought would be mediocre, it became humongous, and you missed out on the ride. So one example I remember still, and I is sort of regrets, is Page Industries.
Oh.
Right. So I looked at Page Industries when it was in its very nascent state, 2000 maybe 4-5 period.
My God.
And I had gone to the US and I was looking around in these shopping malls, and I found that Jockey was a very mid-tier, low to mid-tier brand there, right? Nobody feels that Jockey is aspirational. Jockey is not that great kind of a brand at that point in time. So I carried that thought, that went into my head, came back. What I missed was that in India, Jockey was a premium product. It was something that was different from what at that point in time Rupa and others were doing. And I think it would have gone up 100x from where I looked at. It was something that was on my radar. See, the biggest mistakes are stuff where you've studied, where you've had a thought process, and then you missed out. Because see, most of the time, your acts of omission are bigger. You missed out on 100x. What is the worst that happens when you buy something and it doesn't work out? You get out at 20, 30, worst case 40, 50% drawdowns. Right? Most of the time, even that doesn't happen because you're buying a reasonably good company and you give it some time, it sort of, you can break even and get out.
So would you say this was like a bias you had on the company?
Of course.
Because the fundamentals were good.
So most of, I keep repeating this all the time. Investing is 80% psychology. Right? Your mind will play tricks with you. And even in quant systems, right? The whole idea of using more and more quantitative systems is to take out the bias,
Yeah.
right? Psychological bias. But the problem is my system has my bias,
Correct.
right? So you are actually not taking out all biases.
You are the biggest bias.
You are coding in your biases
Yeah.
and trying to eliminate a few of them, by backtesting, by doing whatever. But your fundamental worldview of investing is getting reflected in what you are buying and selling, or what your type of screens are, strategies are.
Wow. Got it.
That is the part
Got it.
that is intriguing, interesting to me.
Abhishek, so honestly, I think this was very, very, very insightful, because I know we spoke a lot of things, and I know it is going to be very impactful for the retail audience as well. But again, I really want to thank you for this. And I know you're a very busy guy, but you've given us some time to do this entire podcast. So really, really thank you from the bottom of my heart, and from all the audience out there as well. And I hope all of you guys learned something as well. But again, thank you, sir. Thanks a lot. Yeah.
Thank you.